Welcome to Investment Sukuk Islamic Bonds. The content of this presentation includes the origin and meaning of Sukuk, bonds, equity shares, and Sukuk, structuring the Sukuk across countries, and benchmarking.
So now, let us first discuss the origin and the meaning of Sukuk. Sukuk followed in the footsteps of the conventional bond for similar reasons, and acquired in the process the title Islamic bonds. It has adopted the strategy of embedding a trade element in its production structures so that the settlement of cash can be made on a deferred basis. The Arabic term sukuk is the plural form of the word sak, but is now used in a singular sense as well. They served as papers representing financial obligations originating from trade and other commercial activities. Islam prohibits the giving and taking of interest. Therefore, the approach to designing sukuk has been different from that of most Islamic financial instruments. Taking the conventional bond structure, the interest rate is fixed, and the contract is wrapped around an asset base involving a deferred payment so that it meets the Sharia requirements. So now, in this part, I will also discuss about bonds, equity shares, and sukuk and their underlying differences. A bond is a debt contract that requires the issuer or debtor to pay each bondholder the principal amount plus interest on a specified date. The bondholders are interested in the assets of the issuer company because their capital and interests are tied to the issuer company. In contrast, sukuk holders have beneficial ownership in the common pool of assets underlying the issue. A bondholder is free to sell the certificate at any time in the bond market for cash at the current price. Such a liberty is not available to a sukuk debt base unless sukuk do not represent pure debt but are a mixed portfolio of debt and tangible assets. The issuer of bonds is free to use the funds raised in any way it deems fit. In contrast, sukuk funds cannot be utilized independently of the purpose for which they are issued. Sukuk certificates are also different from equity certificates. Equity stocks are issued by corporate bodies to be used as a general financial base, normally covering the cost of a fixed asset and a part of working capital. Equities carry no guaranteed returns and are traded on the stock market. In contrast, bonds involve lending money to the company at a fixed interest rate. As such, bonds carry less risk than equity shares.
So let's proceed to the structuring of Sukuk. The structuring of Sukuk is a complex process that involves intricate decision making. So let's see the first kind of Sukuk, which is the Mudaraba Sukuk. So Sukuk in this case are project-specified investments and represent equal value units in Mudaraba assets. The contract is based on the official prospectus, which must provide all relevant information in order to be Sharia compliant. The second kind of sukuk is the Musharaka sukuk, so used for mobilizing funds for establishing a new project, developing an existing one, or financing a business activity based on partnership contracts. The certificate holders becomes the owner of the project or the asset of the activity as per their respective shares. So it's important to take note the Musharaka and Mudaraba are quite similar. In both cases, sukuk holders share profits and losses with the project operator or the entrepreneur. The difference is that in Musharaka, all participants are insiders as shareholders in the corporation. In contrast, sukuk holders under Mudaraba are external suppliers of funds. They normally cannot participate in the decision making or managerial aspects of the business. So let's proceed to the third kind of sukuk, which is the Ijara sukuk. These are sukuk that represent the ownership of equal shares in a real estate or in the usufruct of the real estate. They are securities that give their owners the right to own their well-defined real estate that is tied into the lease contract. For an Ijara contract, it's necessary that the asset being leased, whether existing or to be constructed, and the rental are clearly known to their parties. at the time of entering the contract.
Next is Muraba Sukuk. Muraba Sukuk is a debt-based financial instrument and it involves the sale of specified commodities using funds from buyers. Certificate holders of Muraba Sukuk become owners of the commodity and receive revenue from its final sale. It is non-negotiable in the secondary market except at par value. There are three variations of the sukuk. First is an actual sale. Second is a buyback or called buy-al-ina. And third is a tripartite agreement or tawaruk. Next is salam sukuk. Salam sukuk are certificates of equal value for fungible goods. It is issued by a seller of goods and funds from subscribers serve as the purchase price. Certificate holders of salam sukuk become owners of the goods and are entitled from certificate sales or parallel salam. These are dynamic instruments for diverse funding purposes. Sharia requirements include full payment at the sale contract and restrictions on resale before possession at contract maturity. Next is istisna sukuk. Similar to salam, istisna sukuk originates in the pastoral era but extended to manufacturing. Certificates of equal value mobilize funds for producing products owned by certificate holders. Certificate is issued by the manufacturer. Subscribers are buyers of products for future delivery. Parallel istisna allows product sale and it is ideal for large infrastructural projects. This sukuk is debt-based, meaning they are not tradable in the secondary market at a price other than face value, limiting trade.
Sukuk across countries. The global landscape of Islamic finance has expanded rapidly with over 600 Islamic financial institutions operating in over 75 countries. The growth has been particularly notable in Sukuk, a key financial instrument with reported transactions exceeding $800 billion in 2011, constituting 80% of Islamic finance instruments. While Sukuk issuance has reached major financial centers worldwide, its concentration remains in the Middle East and North Africa regions and Southeast Asia, notably led by Malaysia. In the first half of 2012, Malaysia dominated as the top Islamic issuer of Sukuk, capturing 45% of the global market, while HSBC emerged as an industry leader, securing top position in Islamic bond rankings with 10 issuance worth $1.9 billion. However, in the Middle East saw a sharp decline in Sukuk issuance in the second quarter of 2012, falling to $6 billion, one-third of the previous quarter's $16.9 billion. So benchmarking, the use of Sukuk, a key financial instrument in Islamic finance, has seen a significant increase in volume, but concerns persist regarding their Sharia compliance, particularly since 2008 when Sheikh Taqi Usmani highlighted violations of Sharia norms in many Sukuk issuance. Controversies surround the use of INA and Tawaruk in structuring Sukuk, and issues arise in determining markup rates in installment payments. The common practice of benchmarking markup rates on the London Interbank Offered Rates or LIBOR is criticized for being inconsistent with Islamic finance productivity-oriented principles. Suggestions include exploring alternative benchmarks such as using the zakat rate or constructing a composite index of Islamic banks' gross earnings. And the lack of uniformity in Sukuk issuance globally and challenges in compliance and regulations contribute to the controversies and operational complexities surrounding these essential Islamic financial instruments.
Thank you so much for listening. This was presented by Bakong, Duterte, Granados, and Roquillas.